Google just reported one of the strongest growth quarters in big tech. Tesla brought deliveries back and revenue grew more than 25%. Then the market opened. Alphabet fell about 7%. Tesla fell 14.5%. Same reaction, very different earnings. If you're looking at those two sell-offs and seeing the same story, look again. Google's spending a fortune to expand a business that's already growing fast and making real money. Tesla's spending a fortune too, except its core operating profit is shrinking. That's not the same bet. And if you want my answer up front, here it is. Alphabet's quarter was expensive. Tesla's was troubling. Let's see why. First, this wasn't a normal day for the market. Brent crude closed above $100 a barrel. Inflation fears came back. Bond yields rose, and the Nasdaq fell a little over 2%. So no, earnings didn't cause every dollar of these declines. But here's what you can't ignore. Alphabet fell about 5 percentage points more than the Nasdaq. Tesla underperformed it by more than 12. The market was weak. These two stocks were much weaker. And here's the part that trips people up. When you own a stock, you're not buying last quarter's revenue. You're buying a claim on the cash investors think that business can produce in the future. So a company can report good news and still fall. If the price already assumed something even better, good isn't good enough. Let's start with Google. At first glance, there's almost nothing to complain about. Alphabet's revenue reached nearly $120 billion, up 24% from a year ago. Operating income rose 30%. The operating margin improved to 34%. That's a bigger business becoming more profitable. Then you get to Google Cloud. Cloud revenue hit $24.8 billion, up 82%. Its operating profit jumped from $2.8 billion a year ago to $8.8 billion. Put that in plain English. Cloud didn't just grow. It added about $11 billion in quarterly revenue and nearly tripled the profit it produced. That's real demand, real revenue, real profit. So why did investors sell? Because the income statement looked great, but the cash flow statement didn't. Alphabet generated about $39.1 billion in operating cash during the quarter. Sounds good. Except it spent $44.9 billion on capital expenditure. After paying for data centers, chips, networking equipment, and other long-term assets, free cash flow came in at negative $5.9 billion. In other words, Google's operations produced a mountain of cash, and the AI buildout swallowed all of it, plus another $5.9 billion. That's the catch. Now don't confuse investment with waste. A data center built today can support revenue for years. If demand keeps growing, this spending could look smart. But before you call the sell-off an overreaction, look at how quickly the bill is rising. A year ago, Alphabet spent about $22.4 billion on capex in the second quarter. This year, almost $45 billion, same quarter, twice the spending. Here's another way to see it. For every dollar of quarterly revenue, Alphabet invested about 37.5 cents in capital assets. A year ago, it was closer to 23 cents. The business grew. The cost of supporting that growth grew much faster. You can see why investors got nervous. And management didn't stop there. It raised the full-year capex range from $180 to $190 billion to a new range of $195 to $205 billion. The midpoint went up by $15 billion. So what does that actually mean? It means Google isn't asking investors to believe AI will create demand. Cloud's 82% growth already shows the demand. Google's asking them to believe the return will eventually outrun the infrastructure bill. That's a much narrower question, and a much better one. There's also a reason you shouldn't take the headline EPS at face value. Alphabet reported GAAP earnings of $9.11 per share. If you compare that with the $2.89 analysts expected, it looks like Google absolutely crushed the quarter. But you can't compare those numbers directly. Alphabet recorded roughly $99 billion in gains on equity securities, primarily connected to SpaceX. The company says that added about $6.26 to diluted EPS. Strip away that distortion, and Reuters' adjusted figure was $2.85 per share, 4 cents below consensus. The SpaceX gain isn't imaginary. The investment gained value, but it doesn't tell you much about search, YouTube, or cloud. So here's my call on Alphabet. The market's right to question the bill. No company gets a blank check just because it writes AI on the invoice. Still, a 7% drop looks harsh when cloud revenue is up 82% and cloud operating profit has more than tripled. Google is paying heavily for growth. But the growth is already here. That's why I'd call this a payback problem, not a broken business problem. Tesla's different, and this is where the numbers get uncomfortable. If you only looked at demand, you might think the quarter was fine. Tesla delivered just over 480,000 vehicles, up 25%. Revenue reached $28.2 billion, up 26%, and above the analyst consensus compiled by Tesla. More cars, more revenue. So far, so good. Then you reach profit. Tesla's operating expenses climbed 47% to about $4.35 billion. The company points to AI, other research and development, stock-based compensation, and administrative costs. Meanwhile, operating income fell 57% to just $398 million. More sales, less operating profit, and this is the number that matters. Operating margin fell from 4.1% to 1.4%. Put differently, for every $100 in revenue, Tesla kept just $1.40 in operating profit. That's the problem. Tesla didn't lose demand, it lost economic strength. Revenue increased by about $5.7 billion from a year ago. Operating profit fell by roughly $525 million, and the increase in operating expenses alone was about $1.4 billion, more than 3 times Tesla's entire operating profit for the quarter. The company didn't fail to sell. It failed to turn higher sales into better operating earnings, and you can see the same tension in adjusted earnings. Tesla made 33 cents per share. Analysts expected 51. That's a miss of roughly 35%. Revenue beat, profit missed. If you're wondering why the stock fell 14.5%, start there. The profit isn't the only pressure point. Tesla spent about $5.8 billion on capital expenditure during the quarter, up 142% from a year ago. Operating cash flow came in at about $4.7 billion. So after capex, free cash flow was negative by roughly $1.1 billion. Tesla's first negative quarter in more than 2 years. Again, negative cash flow doesn't automatically mean bad investment. Tesla's trying to fund vehicles, batteries, AI infrastructure, autonomy, robotics, and other future businesses at the same time. Some of those bets could become enormous. But here's where Tesla loses me. You can't keep using tomorrow's businesses to excuse today's margin forever. When the core operation keeps only $1.40 from every $100 of revenue, the question isn't just, will the future be big? It's, can today's business afford to build it? Compare that with Alphabet. Google's making huge investments while producing more than $40 billion in quarterly operating profit. Tesla's increasing investment while quarterly operating profit sits below $400 million. Same ambition. A very different cushion. Tesla also had its own SpaceX accounting boost. It recorded a $1 billion pre-tax unrealized gain on the investment. After tax, that added roughly 22 cents to GAAP earnings per share. The accounting isn't identical to Alphabet's, so don't treat the two figures as interchangeable. But the takeaway is simple. When an investment gain is large enough to reshape headline profit, you need to look underneath it. Operating income, cash flow, margin. Those tell you what the actual business did. So, which report was worse? Tesla's. Not because demand disappeared, it didn't. Because sales recovered while operating profit nearly vanished. Alphabet has a payback problem. Tesla has a payback problem and a survival margin problem. Google needs to prove its profitable, fast-growing AI business can eventually outrun the infrastructure bill. Tesla first needs to prove the business paying that bill isn't getting weaker at the same time. That's the difference. Now, neither one-day sell-off settles the long-term case. Google's spending could build a durable infrastructure advantage. Tesla's bets on autonomy, energy, and robotics could create real value. But you don't have to give either company unlimited credit in advance. If you're tracking Alphabet, watch cloud profit against capex. If cloud profit keeps scaling and free cash flow recovers, the build-out's working. If spending keeps outrunning cash, the market's concern wasn't an overreaction. For Tesla, watch operating margin first and free cash flow second. Big delivery numbers won't be enough if each dollar of revenue produces less profit. So when the next earnings headlines arrive, don't stop at revenue growth, and don't stop at EPS. Ask 3 questions. Did the company beat what investors actually expected? How much capital did that growth consume? And once the spending was done, what cash was left? That's how you get from the headline to the business. And in this quarter, it leads to a pretty clear verdict. Alphabet deserves scrutiny. Tesla deserves skepticism. This isn't personalized investment advice. It's my reading of what these numbers actually say.